Great to be with you guys. I was in a Lyft line the other day, or an Uber pool, with Sandra. Is Sandra around? And we just got chatting, and she said, I work at Pivotal, and I said, I work at Kiva. And this talk is the result of that serendipitous encounter. I've seen Pivotal in the office downstairs, and I think I've come here once before to play in a ping pong tournament, but it's good to be with you guys and hopefully telling you a little bit about what we do at Kiva down on the third floor. I just became a dad recently, so if I fall asleep or I'm thinking and talking slowly in this presentation, you can blame Felicity here. Thank you so much. So this is kind of a brief personal intro. This is now kind of subsuming the personal side of my life. I grew up in the UK, moved here, started my career in strategy consulting, came to volunteer at Kiva in the summer of 2009, met the mother of Felicity here. We started dating, then got married, and then I quit consulting, came back to Kiva full-time in 2011. So I've been on the Kiva team now for the last 5 years, growing the Kiva US program that I'm going to focus on telling you guys a little bit about today. I mean, hopefully everyone has heard of Kiva, right? Anyone? Yeah, okay. Has anyone made a loan on Kiva? All right. Okay, awesome. Hopefully we'll have a few more hands later today. Does anyone want to hazard a guess or kind of any thoughts on what comes to mind when you think of Kiva? Microfinance? Yep. All right. Shy bunch. Also, please do kind of interrupt me and stop me with questions as I go through. It's going to be a lot more engaging for everyone if this is a dialogue. We'll have a lot of time for Q&A at the end, but if there's stuff that comes up as I go through, please just shout it out. So for me and for most people, I think Kiva implies this. So we're a crowdfunding platform that does microfinance. I think Kiva was actually one of the first crowdfunding platforms. I think it predated Kickstarter and Indiegogo. Don't hold me to that. This isn't being recorded, right? But the way it works is you log onto our website, kiva.org, you choose a borrower, and at any given time, we'll usually have thousands of entrepreneurs around the world that are up on the website crowdfunding. You make a loan. You can make a loan for as little as $25. The bottom icon here is, I think, really what sets Kiva apart from many other crowdfunding sites. You get repaid. Our repayment rate over close to $1 billion of loans, we're about to pass $1 billion. Our repayment rate is about 97%. So you're almost guaranteed to get that $25 back. And then you can relend it to another entrepreneur, and it just keeps on cycling. I made my first Kiva loan, $25 loan in 2007, and over the last almost decade, that's cycled many, many times. The average loan time is about 1 year. So it feels like you're giving to support entrepreneurs around the world, but it's the gift that keeps on giving, to use a horrible cliche. So people think, it doesn't pay interest. So yeah, you're doing it out from a motivation of philanthropy rather than a motivation of profit or earning an interest rate revenue. Yeah. This is, I think, the other thing that people think of usually when they think about Kiva. I mentioned microfinance, but Kiva was founded in Uganda. Well, I guess our team was here in San Francisco, but the first loan that we made was in Uganda back in 2005. And we work in 85 or so countries around the world today, and 84 of those countries are in the developing world. And this is kind of the brand of Kiva that we're supporting entrepreneurs like this lady in the developing world. These are some of the stats that kind of represent the organization. We've actually now passed 2 million borrowers. This is a little bit old, coming up on $1 billion of loans. There are 110 of us, about 100 of us down on the third floor, and then a few spread out throughout Nairobi and Bangkok and Istanbul throughout the world. And someone makes a loan on Kiva every 7 seconds. And really kind of a lot of volunteers help to power the work that we do. So I said this is kind of the brand of Kiva. This is what most people associate with Kiva. If you go to the website of Kiva, this is kind of most of the imagery you'll get. But in 2011, Kiva launched the Kiva US program, which I'm privileged to lead. So this is, I guess, a more controversial photo than it used to be. But this is Bill Clinton launching Kiva New York in December 2015. Why did Kiva launch in the US? Here's the kind of thinking, really. This chart shows, I saw this in a magazine recently, and I just couldn't help take a photo of it and tweet it. It just blew me away. That since 1978, I guess, CEO pay has gone up by 1,000%. The typical worker's pay has gone up by 10.9%. Hope the CEO of Pivotal is not listening. But that, I mean, just blew me away, right? And so that's income inequality. From a wealth inequality perspective, the situation is actually worse. So this red line is the top 10% of kind of most affluent, most wealthy people in America. And their net worth has roughly doubled or so over the last 3 decades. The median net worth is pretty much exactly flat. And if you're in the bottom 10%, then your median net worth has gone from about $700 in 1983 to negative $2,000 in 2013. So from a wealth perspective, it's not just that the rich are getting richer and the poor are getting richer more slowly, which is a picture on the income side. It's that the rich are getting richer, the poor are getting poorer. And I think, for me, the events of the last week are a big reaction to this chart, among other things. So Kiva, we believe entrepreneurship can reverse this trend. If you're a small business owner, you are 2.5 times wealthier than a non-small business owner. And it's small businesses that are creating jobs in our society, in our economy. So I love this quote, 2/3 of net new jobs in the US are being created by new firms that are less than 5 years old. If you want to ease income inequality, what you want are more new firms starting up and seeking employees. So if the problem is wealth inequality, one way that we can help to combat that problem is by investing in micro businesses, young early stage firms, small businesses. But that's not happening in America right now. This is a pretty striking chart. The green line here, I don't know exactly what the y-axis means, but essentially it's saying that the number of new firms starting up in America is declining, or the percentage kind of firms that are starting up is declining. And since the Great Recession, the number of firms closing down has exceeded the number of firms starting up for the first time since records began. So entrepreneurship is really, we kind of obviously don't really feel that here in Silicon Valley, but nationwide, this is a really, really concerning trend. And if you look at the entrepreneurial activity of millennials versus older generations, my generation is just not starting businesses like my parents' generation did. We believe one of the reasons why people are not opening businesses, starting businesses, is because of a lack of access to capital. This shows that since 2000, large business loans have gone up. Small business loans have gone down a little bit. Micro business loans, which is where we focus. So micro businesses is like 5 employees or less. Micro business loans are really coming down. So the logical flow, right, is like wealth inequality is bad in this country and getting worse. Entrepreneurship can help to combat wealth inequality, but entrepreneurship is on the decline in part because of a lack of access to capital, and that's where we come in. And hopefully, as a Kiva US team, we can be empowering entrepreneurs that conventional lenders, profit-driven kind of banks might be unable or unwilling to serve. And here are some of our lenders. There's a lot of dog lenders on Kiva and cat lenders on Kiva. Yeah, lots of pets lending on Kiva. And this is my dad and this is my mom. So this work in practice. Let me give you one example of this guy, Victor, who's a friend of mine. So in 2011, we launched our Kiva US team. Victor was looking to open a coffee shop. He's originally from Mexico. He'd been working in the coffee industry as like a barista for the last decade or so, slowly building up his personal savings. Super entrepreneurial, super industrious guy. He needed a little bit of extra cash so that he could finish the construction of his coffee shop, which was in the outer mission, and open the doors. But he knocked on the doors of kind of every bank in town. Actually, he probably didn't even bother to do that because he knew he would never qualify for a bank loan, a small business loan from a bank. But even non-profit lenders were kind of just saying no to him. He was a startup business. He didn't have much collateral. He didn't have much credit score. Those are kind of some of the things that typically exclude an entrepreneur like Victor. But he got funded for a $5,000 loan on Kiva. This is a picture of his trustee. This is a non-profit organization that works with entrepreneurs like Victor called Meta. Does anyone know La Cocina? They have a really awesome brand. They work with immigrant women, food entrepreneurs, so they've endorsed a number of their entrepreneurs to get loans with us. So Meta vouched for Victor's character, and he got a $5,000 loan from, I think it was 67 lenders from around the world. And just put yourself in the shoes of Victor. You've been hearing no time and again from every financial institution whose door you've knocked on. Well, now these 67 people, individual people whose photos you can see, out of the goodness of their heart, lend you $25 each or $50, $100 here and there, and say, yes, I'm willing to trust you with this loan. Pay me back. Good luck with your business. Every time Victor gets funded, we send him an email saying, hey, Jonny just funded your loan, Heidi just funded your loan, Sam just funded your loan. And it's just, we've heard this again and again from our borrowers, it's just incredibly empowering on an emotional level to feel like when everyone is saying no to you, these 67 strangers, many of them, some of them are his friends and family, but many of them are strangers, are stepping up and saying yes so that he can open this coffee shop. So he paid this $5K loan back, then he took out a $10K loan to open a second coffee shop, and probably the most entrepreneurial guy I've ever met. So Meta was his trustee. They endorsed Victor. Then Victor endorsed his friend Rocio, who has a cleaning business. And then Rocio endorsed her friend Eva. So our vision is that we're kind of reaching out to Victor through this community-based nonprofit partner, Meta, and then Victor's helping us to get the word out in the Latino community, in this case, in San Francisco. There's a real, oftentimes in low-income communities, there's a real lack of trust in financial institutions. People have got burned a ton of times. When we say, hey, 0 interest, no fees, people always think that's too good to be true. Where's the catch? So Victor can help us to establish credibility in the eyes of his community. And Opportunity Fund are a non-profit micro-lender. They're an awesome organization. And I was stoked to get an email in my inbox. I guess this is from March 2015. So this is now 4 years after we made our first loan to Victor. Now he's qualified for a 10K loan from Opportunity Fund to open his third coffee shop in South San Francisco. And this is really the vision that we have, that we're taking someone that was just totally outside of the financial sector, and over time, we're enabling them to start a business, build up their cash flows, build up their credit score, and then kind of mainstreaming them into the more formal financial sector. So this is the kind of entrepreneur that we're funding. So Victor is a Latino guy here in San Francisco. This is Sebastian Jackson. He has this barbershop in inner city Detroit. He cut my hair back in 2012. That's actually one of the things that we really want to encourage and do more of on Kiva, is that when we fund Sebastian with interest-free loan, it's not just about the money, but it's also about, if you're getting crowdfunded by 200 people, that's 200 potential customers for your barbershop, or 200 potential brand ambassadors, or 200 people that can connect with you on LinkedIn and potentially open up a door for you. So we talk a lot about social capital as well as financial capital. This guy is just down the road from Ferguson, Missouri. This is a Native American artist in rural Minnesota. This is a disabled veteran in Waterloo, Iowa. This guy, Kevin, has this taxi company in Dallas, Texas. This is the kind of loans that we want to be making. 2% of SBA loan volume, Small Business Administration, this is like the government agency. I read that 2% of SBA loan volume goes to African American owned businesses. African Americans, 12% of the population, 7% of small business owners, 2% of SBA loan volume, and 1% of VC funding. For us, it's 28%. So That's really where our focus is. You know, the people that tend to be excluded by the conventional financial sector, encouraging them, empowering them with small business loans that they can use to create businesses in their communities, which hopefully, going back to that earlier slide, can in the long run help to ease the deteriorating wealth inequality situation we have in this country. So that's like why the US. I'm just going to keep going, but please do interrupt me and stop me. Here's another way in which my team's different. I was chatting with Ben before about some of it's kind of interesting. We're like a kind of an entrepreneurial, like small team within Kiva. One of the big ways we're different is we are focused on the US rather than the developing world. The second way we're different is that we lend directly to entrepreneurs. So most of the time on Kiva, when we crowdfund a loan, we send it to an intermediary organization called a microfinance institution. Like Grameen Bank is the most famous one that Muhammad Yunus pioneered and won the Nobel Peace Prize for in Bangladesh. But so once we've crowdfunded the loan on Kiva, we send it to the MFI, and the MFI is responsible for administering the loan to the borrower and collecting repayments. And by the way, the MFI usually charges an interest rate to the borrower. So the borrower might be paying a 20% interest rate. The MFI keeps that to cover their operating costs, and Kiva is kind of lending to the MFI at 0% interest. But one of the second kind of big difference of my team, which used to be called Kiva Zip when we set it up as a pilot back in 2011, and we recently, this year, integrated it back into the main Kiva website and dropped the zip, and now we're just one Kiva again. But the second big difference is we lend directly to entrepreneurs. So rather than going through that MFI intermediary, we lend directly to the small business owner. We actually launched Kiva Zip in 2011 in Kenya, as well as the US, and we were using this mobile payments platform called M-Pesa to send loans directly to the mobile phones of borrowers. It was really, really cool. But unfortunately, we had to shut that down due to lack of resources. But so this more direct model of lending is the second big difference of our team. Okay, be less shy. Kiva has made like almost $1 billion of loans, like with these MFI, microfinance institution, intermediated loans. In 2011, the founders hire me and this other guy to come in and experiment with this new direct to the entrepreneur model called the Kiva Zip pilot. Why would Kiva want to lend direct rather than through MFI intermediaries? Any ideas? What's that?
Money to the entrepreneur not going through.
Yeah, essentially. So I usually talk about that as like cost efficiencies. So if currently there's like Kiva and the MFI, there might be some MFIs where they're not operating as efficiently as they could be. Kiva's a technology company. Can we lower the costs of doing microfinance and pass those cost savings onto the borrower in the form of lower interest rates? So yeah, our interest rate is 0%. We have no fees. Clearly, we have some costs. We can talk about economic sustainability later, maybe. But yeah, that's certainly one of the big reasons. Any other ideas? Yeah. So that's a huge one. Kiva's mission is to connect people through lending to alleviate poverty. And when you have the MFI intermediary, it's not impossible, but it's a little bit harder to facilitate, promote connections between the 200 lenders on that loan and the borrower that's benefiting from it. If we have a direct line of communication to the entrepreneur, we can encourage borrowers and lenders to talk to each other. You know, that example I gave earlier of Sebastian in Detroit getting customers for his barbershop or getting LinkedIn connections, this direct model, I think makes it a little bit easier to facilitate that personal connection between the borrowers and lenders, which is a really cool aspect of crowdfunding, you know? It's the same on Kickstarter or Indiegogo. Yeah, you're getting like funding, but you're also getting connections to all these people that like really are passionate about your project. Any other ideas? There's two more kind of big things that I talk about. The first one is, whoa, that didn't work. Okay, the first one is expanding access. So imagine that you're like, imagine that an MFI has certain underwriting criteria. They don't want to lend to a startup business. They require a minimum FICO score of 600. If we're putting the lending decisions in the hands of our community of 2 million lenders from around the world who are motivated by philanthropy, not profit, can we expand access to entrepreneurs that previously are used to hearing no, like Victor? So it's about expanding access, it's about lowering the cost of capital, and it's about connections. So that's why we did it, and we're 5 years into this direct experiment now, and it's going well enough that Kiva took the big decision to reintegrate the separate Kiva Zip brand and website into the main Kiva website, and I'm sure you guys can all appreciate the complexity of that pretty Herculean engineering task. Yeah.
A little bit that seems like it comes down to brand recognition. Do you see that more people recognize the Kiva brand now through the direct versus the IRAP?
Yeah, that's actually a great call. I wasn't even going to talk on that, but when we launched the Kiva Zip pilot, we talked solely about those three aims. Expand access by kind of empowering our lender community to make the decisions on who gets funded, lower the cost of capital, more closely connect our users. What's emerged over the last 5 years is actually a fourth reason, and probably the most powerful, compelling reason of all. Every year for the last 7 or 8 years, Kiva's been seeing fewer and fewer first-time lenders sign up to use the platform. We were on Oprah Winfrey's favorite things in 2007, and that was like explosion. And you know, Muhammad Yunus won the Nobel Peace Prize, I think it was 2006. Like I said earlier, Kiva kind of was one of the first crowdfunding platforms in the marketplace. Over the last years, there's been other crowdfunding platforms. The gloss, the sheen has come off microfinance a little bit. And I think there's a number of reasons why our lender base has kind of grown more slowly. The fourth and maybe most powerful reason for launching this direct model is that now we are encouraging and even requiring the small business owners like Victor or Sebastian to recruit their friends and family to lend to them. And actually, that's how we underwrite loans. So before you go publicly on the Kiva website to crowdfund from our lenders, you've got to recruit 15, 20 friends and family from your network to lend to you. So this is one of the main ways in which we're trying to underwrite loans based on character, an entrepreneur's character, not their credit score. Can you find 15 people from your friends and family network to lend you $25 on Kiva? If you can, we put you publicly on our website. And yeah, we're not charging you anything in terms of interest rate or fee, but we're kind of taxing you because you just grew our lender base by 15 people. And so this year, I think, will be the first year when Kiva's new lenders actually starts to grow again. And roughly half of new lenders in the last quarter came from our US team and from the small business owners that we're making loans to, bringing their friends and family network to lend to them. So it's about brand awareness. It's about kind of growing the lender base. That's how every other crowdfunding platform has grown. Indiegogo, Kickstarter, GoFundMe. If you guys know Donors Choose, it's a way that you can crowdfund teachers' projects. It's the project owner promoting the project to their network, and that's how you get, project backers, or in our case, lenders. So we talk about this a lot. I'll probably come into land soon. We talk about Kiva being about reinvention finance system based on people. So that's like a buzzword. So what does it mean? So I talked about underwriting based on character, not credit. So we talk about social underwriting. Can we look beyond your FICO score? Can we look beyond how much money is in your bank account or how many years of cash flow you have for your business and try and get a sense of who you are as a person, which is really the only way we're going to be able to break this situation where, if you imagine our tax system is very, very progressive, right? And few people would dispute that that's a good thing. Herman Cain, I think, wants a 10% flat tax. That is not a progressive tax system, but most people agree the rich should pay a higher percentage income tax rate than the poor. That is a progressive system. Our finance system, however it's been built up, is unbelievably regressive, right? I don't pay any fees to have a bank account. If I need to borrow money, I can do so very, very cheaply. If I was in that bottom 10% of people from a wealth perspective, you pay fees to have a bank account. And you go overdrawn a lot more frequently, so you get fees there. And if you need to borrow money, then you have to go to a payday lender and pay hundreds of percentage points of APR. So you borrow $5,000 and you pay back $15,000. It's an unbelievably regressive system, and it's just trapping people in poverty. And it's why that wealth inequality chart is like doing that right now. So, if you're underwriting loans based on credit, then the poor are always going to have higher interest rates and are always going to be more excluded. If we can try to find a new innovative way of underwriting them, which is what we've done with this invite 15 lenders to fund you requirement, then can we underwrite loans based on character rather than credit, and can we try to break that cycle? So that's one way we're trying to reimagine a finance system based on people. I mentioned this earlier. We're not just providing loans, but we're also trying to provide customers, connections, business advisors, brand ambassadors, strengthen entrepreneurs, social capital, as well as financial capital. This, for me, is the most powerful way of all. This is the thing that I get most excited about. Democracy has done some interesting things in my home country and in this country recently, but I still have faith in democracy. It used to be that encyclopedias were written by the encyclopedia editor, right? There was a hierarchy, but ultimately, the editor-in-chief would get to decide which articles went in the encyclopedia and what those articles said, the slant of those articles. Nowadays, we have Wikipedia, where any of us can democratically decide which articles go in the encyclopedia and what the slant is. And we're trying to do the same thing for the finance system. And we believe the data kind of backs this up, that if you concentrate underwriting decision-making in the hands of gatekeepers, then you get 1% of VC funding going to African-American entrepreneurs. Like, VCs are white. They fund white entrepreneurs. Like, that's maybe a controversial thing to say, but it is 1%. We believe that if we kind of open up underwriting and empower our decentralized, democratized community of 1 million lenders around the world to make these decisions, then we can expand access to capital. We can make fairer underwriting decisions. Like, imagine if and we can also kind of have a diversity of trade-offs between risk and social impact. We make a lot of loans to ex-offenders on the Kiva US program, right? Imagine that you have a bank that is looking for like a 95% repayment rate on their loans, or a 96% repayment rate. And you have 20 ex-offenders come to that bank and say, can I have a small business loan? And each one of them would have a probability of repaying that loan of 95%. The bank would reject every one of those 20 loans in this hypothetical world where you can kind of perfectly assess the probability of repayment. So the bank rejects all 20 of those loans. But if we made loans to those 20 entrepreneurs, 19 of them would repay and create kind of businesses and hopefully grow businesses themselves. But our system, looking for a 96% repayment rate, rejects all 20. So what we're saying at Kiva is, if we can empower our lenders to make that decision, some of those lenders might say, you know what, I want a repayment rate of 96%, so I vote no with my $25. But I would say, sure, I vote yes. I'm okay with a 95% repayment rate if I'm empowering this guy that used to be in prison to create a business for himself and an income base for his family. And so like each lender in our community gets to assert their own trade-off between risk and impact, which I think is really, really powerful. And we're just small, and we're a non-profit, so we don't have any money. And so we're very small and growing much less quickly than we would be if we had a lot of VC funding. But I'm excited about this concept, and over time I hope we can grow it. And maybe the biggest impact that we have is over time to kind of demonstrate something to the for-profit sector, that a bigger kind of for-profit VC-backed company can come in and say, wow, maybe there's something in trying to underwrite people based on that private fundraising 15-lender requirement. And hey, maybe there's like a way that we could build a Wikipedia for finance and democratize access to small business loan capital. That's the thing probably I'm most excited about of everything I do, which I'm pretty excited about a lot of stuff. So democratically, together we can together with Otis here and Mittens over there, we can be a part of the solution. So if you go to kiva.org, you can find some of these entrepreneurs around the world. For democracy to work, people need to stand up and vote. So Would love it if you guys could vote with $25, and there's a 97% chance that you get your money back. That's all I had. Any questions? Yeah. That's a great question. We cover our operating costs. Two main revenue streams. One is grants, big grants. Google.org just gave us $500,000. The San Francisco Foundation gave us $500,000 to grow our work in the Bay Area. That covers about 1/3 of our costs. The other 2/3 is from our lender base. So if we have 1 million people make a loan on Kiva this year, when you make a $25 loan, there's an option to make a donation on top of that $25 to cover our costs. And so typically we get about 5%. Actually, I guess with a few other little bits, it's more like 7%. So if we make $150 million of loans this year, it's about $10 million of revenue. Now, like, sometimes we ask, like, is Kiva a social enterprise? For me, probably the answer is no. At least, like, conventional definition of social enterprise is you have an earned revenue stream that is increasingly covering your operating costs. Is that an earned revenue stream? You could argue it is. It's certainly broadly based. It's certainly very predictable and I think sustainable, but it is a pure donation. But my vision would be over the long term, if our loan volume keeps growing at a faster rate than our costs, then one day that lender source revenue will fully cover our costs, and we won't actually be reliant on grant funding anymore, which can be unpredictable, can be relatively expensive to raise. So that's kind of the long-term vision. And like every time someone lends or signs up to lend on Kiva, there is a lifetime value of that lender. So imagine over the lifetime of their lending on Kiva, they might do $300 of loans, and 5% of that is revenue to us in donations. So that's $15 of revenue, lifetime revenue per user. So, you know, when we ask a borrower to recruit 20 people from their network, we're not charging them an interest rate, we're not charging them a fee. But if those 20 people have a lifetime value of $15, that's a $300 revenue stream that borrower is helping us to bring in, which on a $6,000 average loan size is like the equivalent of charging a 5% interest rate or 5% fee. So that's kind of the vision for the economic sustainability. Yeah.
Can you talk about how Kiva thinks about attracting and retaining talent in their employee base?
Yeah.
I'm wondering if it's more nuanced than maybe one might guess at the surface. Like,
What do you mean by more nuanced?
Well, if I was to ask the question for someone who didn't have a lot of background, they might say, well, then they probably look for people who identify with the cause, motivated to participate in the cause, and necessarily have, say, motivations to go work for an organization that's trying to maximize profitability or have a big windfall to return to employees. I guess it's not that simple. I guess it's more nuanced than that. So I'm wondering what the experiences of the organization have been in terms of how they approach acquiring and retaining talent when that talent can go elsewhere.
Yeah, that's a really good question. There's this awesome TED Talk by this guy, I think it's a TED Talk, by this guy called Dan Pallotta. Has anyone seen it? It's called The Way We Think About Nonprofits is Dead Wrong. I'd really, really encourage you guys to watch this TED Talk. It kind of is paradigm shifting. The two things above all that I would highlight in this talk. The first is, he talks about Amazon, right? And how the long-term mission of Amazon as a for-profit company is kind of maximizing shareholder returns. I mean, obviously it's other stuff as well, but like it's a for-profit company. It's about kind of, you know, maximizing profit in the long run. But in the early years of Amazon, they didn't return a cent of profit to shareholders. They invested everything in infrastructure and growing the company and building for the future and building for the scale, right? Which is what you do as a for-profit company. If a nonprofit were to do the same thing, a nonprofit's long-term mission is to have an impact in the community. For us, it's alleviate poverty through lending. So that's our mission. If we said we're going to defer going after our mission, just as Amazon deferred going after profit for a number of years, so that we take that money that we would have invested in the mission and we invest it in infrastructure and building for scale, No funder would allow that nonprofit to do that. And that is like a hugely problematic, like structural challenge that the nonprofit sector faces. That there's this horrible like incentive to kind of have a short-term impact. Like you always hear nonprofits brag about, oh, well, 100% of our funding is going to do the operations rather than overhead. But like no for-profit company would brag about that because then you're not building the infrastructure for long-term growth. So that's one challenge he highlights. The second one, to your point, is he says it's really, really problematic for the nonprofit sector that salaries in the nonprofit sector are so much lower than in the for-profit sector. And you know, if you look at like the top CEOs of nonprofits versus the top CEOs of for-profits, or like the executive level, there's a huge gap. And when you come out of college, you could earn 50K at Kiva or 70K at Google. You know, so it's a 20K gap and a 40% gap. Like after a few years, I'm 10 years into my career, you know, it's like probably 100K at Kiva and 300K at Google, or that kind of order of magnitude. And it's like, well, now it's a 200K pay gap and it's a 200% pay gap. And basically, the more senior you go, the bigger the percentage and absolute pay gap is, and harder it is for nonprofits, I think, to recruit and retain the best talent. I'm trying to hire someone on my team right now, and the kind of people I want to hire, it's like a 65% pay cut on what they're earning right now. That's roughly the pay cut I took when I left consulting to come to Kiva. So I think that's a real challenge. So then you kind of, it is nuanced, you're right. Obviously, I'm trying to hire someone who is outstanding at like what they do, whether it's marketing or sales or engineering or product management. But, you know, like when the pay gap is that big, you need to be incredibly motivated by the mission to take that big of a pay cut. So, but then beyond that, I mean, we do kind of standard recruiting practices. So we're kind of posting this job out there. We also have an interns program at Kiva, and a lot of the people on my team, and me as well, have kind of come up through the interns program. So we came to volunteer at Kiva, and then just fell in love with the mission and the culture of the organization, and then stayed. So that's where we find a lot of our guys from, and that's kind of a double-edged sword, right? Because on one hand, you're finding people that are willing to work for free for a few months, so they clearly are very committed to the mission and kind of less motivated by financial considerations, maybe. But on the other hand, that tends to be people that can afford to do that. Like, you know, 2/3 of our loans on my team are to minority entrepreneurs, people of color in the US. None of the 10 people on my team are, well, I guess it's now changed with a couple of recent hires, but like, there's no African Americans on my team, there's no Latin Americans on my team, and you know, one of the challenges of hiring from the volunteer base is that if the only people that can afford to volunteer are from maybe more affluent backgrounds, it's harder for us to recruit from low-income populations that we want to be serving on the small business owner side. Yeah. That question of like staff and talent and compensation is, I think, one of the biggest challenges facing Kiva and like the nonprofit sector more generally. Any other questions? Yeah.
How do you measure success for your program?
That is, and you got, okay. You were slow to warm up, but I love these questions. Like these 3 questions, actually, that's actually another huge challenge of the nonprofit sector, right? In the Amazon example, success is extremely unifying and easy to measure. It's a dollar sign. And of course, there's like short-term versus long-term, and you can invest profits back into investment and growth in the short term, which is for long-term profitability. But in the long term, it's very, very clear. Are we growing profit? In the nonprofit sector, it is the opposite of clear, right? Like this year, our team will make roughly 1,200 loans, and 2/3 of them will be to minority entrepreneurs, and the median income will be $40,000. Next year, what if we doubled that, but like the median income of those borrowers increased and the depth of impact that we were having was diluted. Versus what if we kept it the same, 1,200, but like we were really reaching like really low income, financially excluded clients. Which is the better outcome? I don't know. There's really no right answer. It makes it really hard, actually. It's just, there's not that unifying kind of objective. And you just have to kind of trust yourself to strike the right balance. And I think as a lender, I think lending is one of the hardest businesses to do. Like most business, like I used to work as a consultant for Coca-Cola. They didn't care who they sold a can of Coke to, right? If anyone is willing to buy a Coke, then that's great. We have to be really careful about who we sell our loans to, right? Because they got to pay it back. So that's kind of hard. When Coke sells a can of Coke, that's it. Their job is done. They like kind of wash their hands of the customer. For us, that loan might be 3 years in term. So we've got to follow up with that borrower for the next 3 years and try and get them to keep making monthly repayments on their loan. So I think lending is a really hard industry. And then, by the way, when you add in like the crowdfunding element, so now you don't just have one customer, small business owners, you have two customers, small business owners and lenders, then it's all, it all kind of complicates it. But the reason I said that was because we've got to think about a repayment rate as well. So we're like growing the business, which is part of the success. We're thinking about the depth of our impact, which is part of the success. We're thinking about the repayment rate, which is part of the success. We also, I guess, got to think about the economic sustainability question and, you know, are we setting ourselves up on a kind of sound long-term financial footing? So long-winded answer, like there's no clear answer as to whether it's better that I make 3,000 loans next year with a relatively shallow impact or 1,000 loans with a super deep impact. And you just got to kind of trust yourself, I think, to strike the right balance over the long term. Then, like, how we assess the depth of impact is another question altogether. You know, like, and another thing that I think the nonprofit sector struggles with. Think of this like incentivization question. We did an impact survey recently, and the 165 respondents said that on average they created 1.2 jobs after receiving their Kiva loan. Right? Now, you guys are all smart, kind of probably analytical people. That is very, very different to saying Kiva, our Kiva program, our loans, caused 1.2 jobs to be created, right? There's a correlation, but there's absolutely zero proof of causation. But you know, in trying to raise grant funding to cover my team's salary, I'm highly incentivized to claim causation for those 1.2. And the foundations that are funding me and the corporations that are funding me, they don't want their grant funding dollars to be going to support nonprofits that are like not having a big impact. So they're also incentivized to claim the 1.2. So there's a big kind of question for me around incentives and like accurate impact assessment in the nonprofit sector. So that's another challenge. How do we assess that impact with integrity over time? Especially when, you know, for me we're not going to see a movement in that wealth inequality chart anytime soon. So I think sometimes the delta that our loans are causing is going to be small and kind of tough to measure. Any more outstanding questions? Yeah?
Do you open source any of your software, like, or your model? Like, for example, there are probably entrepreneurs in other parts of the world that like the Kiva model and want to adopt a similar model, but like they understand the local context way better than probably Kiva does. Like Ramde, I don't know if you've heard of it.
What's the name?
Ramde, it's a microfinance in India. Like
we work with one in India called Milat.
Okay, yeah, that's a different one. But
yeah,
basically, they're following a very similar model to Kiva. But it could be like your software system is pretty much very similar on what kinds of. So do you all collaborate with other microfinance like organizations across the world on the software part of it? Because if you all have software people like doing the same thing for a better, bigger cause,
yeah, I think we have a partnership with Milap. I don't know to what extent we've collaborated on the software. We're kind of in the long term, I think, trying to get more of our code base to be open source. which would very much be kind of in the spirit of Kiva's mission. But yeah, I don't think we've done too much in terms of collaboration with the organizations that you mentioned. I'd love to do that over time. I'd also love to take this direct model, which is currently in the US, and expand it to other countries in the world. And maybe that's in partnership with folks on the ground who have experience of the local market. The Kenya side of this direct program is not around anymore. I think that was probably more resource constraints and lack of understanding of the local market, but it is an interesting data point. I like the jacket, by the way. I'm a Man U fan as well. Yeah.
Roughly what percentage of the loans are first-time lenders versus someone who's lending for at least the second time?
Vast majority is from existing lenders. And I mentioned earlier, the kind of growth rate of new lenders in Kiva has been slowing down. On our team in the US, a much higher proportion is from new lenders because the borrower is required to get those 15 people from their network to lend to them. So those are almost always new people. And so that's one of the exciting things for us as an organization about this US team is that it's re-energizing new lenders into the lender base. But the vast majority is people re-lending existing money. Hardly,
like 80%, 90%?
re-lending, probably like 90%. In terms of like existing lenders, it's probably like 97%. In terms of existing money, it's probably 90% because some of the existing lenders deposit new money in.
Sorry, follow-up question.
Yeah.
What have you noticed are the major trends in reasons why people keep lending? What about what Kiva does, if anything, have you seen that contributes to or influences the likelihood of people lending?
Yeah, that's a good question. I think that, the model is just huge, right? The model is so powerful. We boast that 90% of the loans that go public on the Kiva website to our US small businesses get funded. That is a much, much higher figure than any other crowdfunding platform that I've ever seen. Like Indiegogo, I believe, is 15%, so 15% of the projects reach their goal, although oftentimes the goals are bigger. But the point is that is happening because on Kiva, you get an email saying, hey, you've got $25 of credit, log back in and re-lend it. So the model itself is extremely conducive to this re-lending. And it's $25, right? So it's like almost more hassle to like take it out of your account than to just log in and re-lend it. And I think then kind of the propensity to relend is probably based on like the kind of frequency of interaction. So for example, we do loans that are 3 years in term. Actually, we do some loans to students that are like 10 years in term. And so if you make your first $25 loan on Kiva to a student loan that's 10 years in duration, if it's 10 years before you get the email that says, hey, now finally you've got $25 back in your account, not log back in and relend it, who knows where you are in 10 years. But if you make a loan that's 3 months in duration, then in 3 months' time, oh yeah, Kiva, wow, like I got it back in my account. I got the email saying why not log in and relend it. And I think those second group of people are probably more likely to become like repeat and engaged lenders over time. Yeah?
I guess I was wondering, how do you think the events of the past week might affect Kiva going forward?
Yeah, that's a good question. I was walking to work on Wednesday, and I was kind of saddened by the results of the election. But I was incredibly proud to be working at Kiva and galvanized about the work that we're doing. So if my reaction is anything to go by, then I hope it might galvanize people and say, you know, I think there's 2 reasons why people voted for Trump. The first is economic. It's kind of what I was hinting at earlier. What we're trying to do is help those blue-collar communities in Ohio, Pennsylvania, Milwaukee. So I hope that what we're doing is kind of tackling the economic problem. The other reason I think people voted was kind of an us and them mentality. And for me, like, our finance system right now, I invest money in Wells Fargo, and that money goes to support entrepreneurs, right? Or kind of people getting mortgages or wherever else it's going. The connection is happening in our finance system. I just can't see it in Wells Fargo. But on Kiva, you can see it. You can see exactly who your money is going to, and this is like super kind of vague and naive and idealistic and kind of long-term, but like in a tiny way, if I'm supporting a Muslim entrepreneur, if I'm supporting a Latino immigrant entrepreneur or an ex-offender, can that in some tiny, tiny way kind of build a bridge of connection? And, you know, going back to that idea of reimagining a finance system based on people, can this be a tiny way that through our finance system, like we are starting to build bridges rather than kind of build up walls and silos and fall into a us and them zero-sum mentality? So I hope that like Kiva can be a small part of the solution, and this might actually kind of galvanize people over the next few years. Yeah.
Yeah, so I just want to say I'm a huge fan of what Kiva's doing.
Thank you.
I'm also, I also love local lending, local economy. I believe in the power of that.
Yeah.
And one thing about Kiva is, you know, you can lend to people all over the world, and you may not have any specific connections to any particular location. It's still overwhelming. So I was wondering, you know, meanwhile, we have this concept of the sister cities, like after World War II, you know, the idea of sister cities came up, where sort of the people in your city have a specific connection to a set of other cities around the world. And I think that's really nice. It's not as important as it used to be, because now, you know, we don't have, you know, you used to have like people who would have 10,000 sister cities, or, you know, sometimes a high school band like raises money to go to sister cities. But it seems that there's sort of an overlay here that builds bridges between specific local communities and other specific local communities. And it'd be really neat if Kiva or organizations like that kind of tapped into that, because I think it'd be more fun to lend to a remote entrepreneur if all the people in my city are lending to remote entrepreneurs in that particular city.
That's a cool idea. I like that idea of like twin cities. I'd also highlight this. This is our homepage, kiva.org. If I come on here, and here's where I hope there are some loans now. But if I type in San Francisco, you guys need to come and help us with our site load speed, by the way. So there are 4 loans here in San Francisco. So we're trying, local lending is a new thing for Kiva. The brand has always been about international lending. The integration of the 2 websites in June of this year has opened up the potential for local lending. And so we need to do a better job of kind of surfacing this and kind of guiding lenders through the process. But yeah, come up, the search bar at the top, San Francisco, and away you go. One last thing, and I'm at time, but yeah, go to kiva.org, make a loan, it's $25. My hope is that that we have a lending teams feature on Kiva. So like PayPal has a lending team, and HP has a lending team, the 4th biggest lending team on Kiva. I'd love to explore a pivotal lending team, so maybe there can be a follow-up about that. But whether it's as a team or as an individual, I hope you consider supporting an entrepreneur, whether here in the Tenderloin or on the other side of the world in Cambodia. Thanks so much for hearing me out.